Welcome back to the Beats the Odds of Business and Wealth podcast, Trevor.
Hey.
We've got a good episode here today. We are going to all become experts on debt and GDP and deficit. By the end of this episode, you will know more than the 343 people that are in Ottawa running the show. So that's my promise to you. And so stick around, because I think this is very important, because if you understand it, the financial decisions that you should make for you and your family would be more clear. So.
Yeah, that makes a lot of sense. When you started talking about this last week, I was curious. I'm like, okay, so we're talking about, everyone's talking about Canada becoming the 51st state.
Yes.
Okay, so 51st state. What's going to happen with that? And I keep telling them, I'm like, okay, so that's kind of like, hooking up with some woman who's got 3 baby daddies, a maxed out credit card. She's got some kind of substance abuse issues, and her family wants to follow her along. And I think it's just a bad choice. And I think today, the video you're going to show and all the things you're going to reveal will just kind of highlight how terrible a choice that would be to become the 51st state of the United States.
Yes. And what circumstances, that's a colorful way, Trevor, of saying out of the frying pan into the fire type of thing, but that's a good example. But, what circumstances could arise where maybe our opinions would change on that, right? Like where that could change. So let's dive into this here. So I have some information here for you today, because what is going to be a heavy spreadsheet and resources. We're going to show our sources on this one, because we want people to understand, because this data is misrepresented, and I think it's misrepresented quite a bit, and to the average person doesn't understand. And you get politicians, talking heads, just talking about debt. How much debt? What are the ratios? It's like, this is not Dave Ramsey here where debt is bad. We use debt to build wealth, but the ratios matter. It's, the same level of debt for one person or one company could be very, very healthy. But, on another person, it could be catastrophic, because the ratios are what matter. Okay. And we're going to walk through this. And this is commonly what you see here. And I have column B here is in Canadian dollars, and column C is in US dollars. It doesn't actually matter. It's because, again, it's the ratios that matter, as long as you're consistent in it. And so what is commonly reported in the media, that is, you see reported debt to GDP around 120%. Okay, so that means the reported debt in Canada at 3.8 trillion.
Okay,
3,805 billion, and people need to start understanding trillies and billies, because that's how things are measured for now, until we got to get to quadrillions. But we're gonna go for trillies and billies for now. Okay, we have a GDP of just under 3.2 trillion. So we have 3,174 billion. That means our debt divided by our GDP is 120%. Okay. Conversely, on the U.S., you have $36,974 billion of reported debt, and you have a GDP of $30,069 billion for 123%. Let's call them the same. Let's just say this is roughly the same, but they're not the same. They are not the same, and we'll drill into it to show you what this is. And so, kind of some of the sources here. Let's look at the reported debt to GDP here. We'll look at the U.S. one first. So the U.S. one, here you go, USDebtClock.org, 36,974 billion. We'll round it up there. Okay, and the GDP, 30,069 billion. Okay, so that's common. People are used to seeing that. But the number we're looking at on reported debt for Canada, I'm going to pull this up, make sure I got the right one here. Okay. When you're hearing this 3.8 trillion here, what does that actually mean? Okay, where is that actually coming from? That 120%, because I would say most people don't even ever hear the 3.8. They just hear 120%.
Right.
And they're just like, okay, it's 120%. US is 123. It's the same. It's not the same. The devil's in the details here. Okay. Okay, so, and I'm going to go down here, and this is from the StatsCan website. This is December 31st, 2024. Okay. Financial liabilities. Okay, here you go. 3,805 billion. That's where that's coming from. Okay. And our GDP, again, on the StatsCan website here, I took this one, 143 billion. I guess I have 174. It's a little offset. 3,174 billion.
Okay.
So here we are. Here's the GDP. A little offset in the time period here because that's Q1 and the debt's on 2024, but it's going to be a percentage point immaterial. Okay, that's where you're getting it. Okay, and then on the U.S., the 36 versus the 30. Here is the first important point. Okay, this U.S. debt that's commonly reported is U.S. federal government debt.
Okay, so federal debt, entire country supposedly.
Just the federal government. Yeah, it's just the federal government. Okay. But when you hear 3 trillion, if you hear 120% in Canada, what you're looking at is actually consolidated Canadian government debt.
So what does that mean for the layperson? What does consolidated government debt mean?
What that means is that's the federal government, that's the provincial government, and that's the municipal and local governments all together in one.
Okay.
It's all together in one. So these are not the same. So when you hear these debt to GDP numbers around 120%, as if they're the same, they're not. The US one at 123% is just the federal government, okay, debt versus GDP. And Canada at 120% is the federal government plus the provincial government plus the municipal and local governments. Okay? So that's the first difference. So I'm going to expand this out here, and we're going to look at another chart. So, and then the ones that the liberal talking heads like to throw up at you to say how amazing Canada is, which is also misleading, by the way. Sure. It's also misleading, is they call it net federal debt. And I want to show you how nefarious net federal, and you'll see this one on the, OECD data and stuff. They call it net federal debt. And they will get a number around 30%. And people are like, well, what the heck? How did it go from 120 to 30? Like, what happened there, right? And you'll see that the U.S. government doesn't move that much. So, like, why is it vastly different when they start talking about net federal debt? What net federal debt is? Okay, so how does it go? How does the debt, go to 30%? It's because the net federal debt would be around 906 billion, not even a trillion. GDP is still the same. GDP is still the same in this calculation. 3,174 billion on the Canadian side. That's in CAD. 30,069 billion on the US side. That's in USD. Okay. How do they get this 30%? So how do they get the 906 billion? That's the key. Here's where the 906 billion comes from. So we go back to the same StatsCan website. Okay. Instead of going consolidated government, you can separate it here. Federal government, provincial and territorial government, local government, which is, the cities, and CPP. Okay, so it's just the federal government. Okay, when you look at the debt of just the federal government, what you start getting here is you get debt of 1,756 billion. Okay, so that is the first part in our calculation. Okay, 1,756 billion.
Okay.
But then why do we deduct 850 billion? How do they get this net federal debt? They don't like to tell you how they get net federal debt. It sounds good to say we have debt to GDP of 30, but they don't like to say what is net. What are they deducting out? Oh, what are they deducting out? I'll tell you what they're deducting out. And if you go down here to CPP and apply, what they are deducting out is the net financial worth of your CPP fund.
Okay.
So they're saying that's not yours, that's ours. So whenever they try to tell you that CPP, that your debt to GDP is we're the strongest in the G7, is like what they're saying is they've now confiscated your CPP. And here's the number, how they get there. You can see it's like, so you get the 1,756 billion, and then you minus the 850 billion, you get 906 billion of net federal debt. GDP still remains the same, and you're going to get something around 29%. But then people will be like, some people, astute people, are like, okay, I get that, I understand. It's a misrepresented, nefarious number. I get it. But why doesn't the U.S. move that much? Okay, so here is the part where maybe we don't get enough attention on this in Canada, but they're starting to talk about it in the U.S. I start to hear it now about it in the U.S. It's like we still start with the 36,973 billion of U.S. debt. Okay, but then what do we deduct? What does the U.S. have? The U.S. doesn't have CPP. What do they have is Social Security.
Social Security, right.
Okay, Social Security. So what is going on with the U.S. Social Security? This is very, very scary. So this is the U.S. Social Security Trust Fund, okay? Their balance, interesting enough, peaked in 2020 at 2.9 trillion. I want people to understand that. It's like it peaked at 2.9 trillion. We have $1 trillion of assets in our CPP fund. They have close to $3 trillion of assets in there.
10
times the population.
Oh, wow.
10 times the population.
So they're not good savers.
Well, neither are we. Ours is underfunded too, but theirs is like comically underfunded. So, so they have $2,721 billion in their Social Security Trust Fund. Okay, so when you net that off against their debt, the number doesn't change that much. So instead of 36 trillion, you're only looking at 34 trillion. Okay, so when they start talking about net GDP, net debt to GDP, it only moves from say 123% to 114%. Okay, so that's where they start telling you. So when you get the liberal talking heads that say, "Don't worry, our debt is the best in the G7," it's like, well, it's like it's a nefarious number, and we're just looking at different shades of bankruptcy, by the way. But let's that would be the comparison. So when they're talking about net federal debt, okay, so when you start looking at that, it's like it's good, but it's like that means you confiscated my CPP. Okay.
Yeah.
Okay. Let's look at another.
Which is also why they're so worried about getting an Alberta pension plan, because those funds would have to be removed from the CPP, federal CPP, and put into some kind of an Alberta thing. So they wouldn't be able to have that calculation. Am I right?
Yeah. In that calculation, it actually has that $1 trillion includes CPP and QPP, so it includes Quebec. But the reason why they're going to fight over the CPP is, they have $1 trillion of assets, but they would need 1.8 trillion to meet their obligations. So they only have 40% of the money's gone. It's missing, right? It's underfunded. So if people stop paying in tomorrow, they'd be $800 billion short. They need $800 billion to invest and pay out slowly over time to meet their obligations.
Which is why they need more and more new people to come in and start paying into the Ponzi.
The Canada Pension Ponzi. Yes.
All right. Okay.
So here it would be in my view, a more fair way to look at debt to GDP is we should look at total federal, provincial or state, and municipal or local debt. Okay,
fair enough.
And here's the reason why. The reason why this is separated a lot for Canada and not for the U.S. is the U.S. is a republic. So the rationale is that constitutionally they wouldn't have to bail out a state if it went bankrupt, where constitutionally it would appear that the Canadian federal government is more obligated to bail out a province or a territory. That is the rationale. I think that entire rationale is, completely useless, because the governments always bail out too big to fail entities, even private entities, private banks, private insurers, whether they have a constitutional responsibility or not. The answer from the government is always, let's bail them out.
Print the money,
bail them out. So like, I don't think it's useful just because of a technical constitutional difference where they could let someone fail, because let's be honest, did they let the banks fail in 2008? No, they bailed them out.
Yeah.
Did they let Silicon Valley Bank fail? No. Were they constitutionally required to? No. So would they let California go bankrupt? No. They just wouldn't, right? And so like someone could argue with me, but it's like that. But I would say like, that's your opinion, and you're probably right that they should let them fail, but they just won't. So it's not about what I think they should do. It's about what I think they should do. It's about what they would do.
Right.
And so a better way to look at it is that $3.805 trillion, that is our total debt. It's often reported as such in Canada, and we hear that's the common way to report it, and GDP is still the same, $3.1 trillion.
Okay.
But on the U.S., they got about another $4 trillion in state and local debt. Okay, they got about another $4 trillion. Here's some of the states here. I mean, the biggest of such are California, New York, Texas. Okay, but between the three of those alone, they're over $1 trillion. Interesting enough, they actually have more municipal and local debt than they do have state debt. So that's interesting. Tough to get an as-at accounting at any given time with the different reporting, because they are a republic and they are much separate, right, in the reporting standards. So the cutoff date is always different in different jurisdictions. But let's call it $4 trillion approximately. That would be the best estimate I could get for you today. Okay. So that would mean they don't have $36 trillion in debt. They have almost $41 trillion in debt. And so if you were looking for
potentially more because of the municipalities.
Yeah. I think the $4 trillion is probably, that's a reasonable estimate from the research that I have. So, so you're looking at an apples to apples comparison would not be 120 to 123. It would actually be 100, and the 29 to 114 is totally silly because they're confiscating the CPP and they're confiscating the Social Security Trust Fund. Okay, like I don't think that's a useful fund. Like unless any government who is suggesting that that our debt to GDP is 29%, they should also simultaneously be suggesting in their platform that CPP is coming to an end, that we're stopping the program, not changing it, stopping it. Taking the money and stopping it, right? So you can't say, if you want to say the debt to GDP is 30%, that also has to be part of your platform, or else you're misleading people and being disingenuous, okay? So apples to apples comparison here, 120% to 136%. That would be apples to apples. That's all levels of government, whether it's federal, state and provincial, local, municipal, okay, divided by the GDP, okay? 120 versus 136. And you start to see it's like the difference is actually bigger. Okay. It's not here. It's not what the talking heads on CBC and the Liberal government would like you to believe, but it's here. Okay. But debt to GDP on its own is like, to me, it's not actually the number. Like, I don't actually care that much about the number. It's like if I'm looking at this as a corporate entity, we provide fractional CFO services. It's like the debt to GDP is like, it's a quick and dirty number, but it's very, very limited in what it tells me. It's very, very limited in what it tells me. Okay. I'm going to break it down how you should look at it instead. Okay?
Well, people, they never really talk too much about this. Well, they do, but the biggest thing that you see on social media and people are really concerned with is the GDP per capita. GDP per capita. That's what they are always worried about and concerned about and saying, oh, America's so much further ahead. I mean, by that number, yes, they are.
Yes.
However,
I'll show you why we probably shouldn't look at the U.S. as the gold standard. By no means is Canada productive. By no means, I think we've seen some stats recently where Canada is, dead last in G7 GDP growth per capita.
Oh, for sure.
But the U.S. being first in that is basically because of a debt splurge. So that, also it's like one of those realms is like probably there's no excuse for being last, but the reasons for being first are probably not all good.
Right. They have a bigger limit on their credit card.
A bigger debt binge, right? People could go and live better and draw a bunch of equity out of their house and run up some credit cards and personal lines of credit and live well for a while. And that might increase the spending and the output and the economic activity, but like that has its limits, right? And I think the U.S. is, closer and closer to touching those limits every day. So let's look on like how metrics that are probably more useful than debt to GDP.
Sure.
Okay, so I'm going to cover this one here. This is the federal government debt as a percentage of the revenue. Okay, so the federal government on the Canadian side brings in $1 trillion. The federal government debt in Canada is $1,756 billion. That's just the federal government debt. Okay, so I have to go back here. Let's show you how to find this on the Stats Canada website here. And I encourage people to look at this. You don't have to trust this. You can just go look at it. It's a statement of government operations and balance sheet, government's financial statistics. It's given to us every year. And I'm just going to go to the federal government here. Apply. And bang, these numbers are not that cryptid here. So we have the 1.7, which I believe we covered before, which would be the total liabilities, $1,756 billion. Okay.
Yep.
And then you have the federal government revenue, $496 billion. Okay. So that's our ratio. So basically, the federal government debt is 3 times the size of the revenue. Okay. That's a concerning number. Okay. That's a concerning number as it is. So like GDP per capita, it's like, okay, we've kind of established that Canada is slightly better off on total GDP than the U.S. GDP per capita is a different discussion for different reasons. Okay, but now we're looking at why debt to GDP itself is somewhat of a misleading number. Okay, the U.S. on the other hand is they have $36,974 billion. Okay, so they got $36,974 billion. Here's their debt. Here's their GDP. Okay, and here is their revenue. This is their total revenue, $5,157 billion. Okay, this is why it was kind of funny. People listening to Trump say he's going to get rid of personal taxes, so by tariffs. Yeah. So the entire U.S. trade deficit is $1.3 trillion, and the amount that they generate in income tax revenue is $2.6 trillion. I'm sorry, you're not going to tariff $1.3 trillion trade deficit to replace $2.6 trillion in revenue. It sounds good, but it's not going to happen. And all politicians lie to you. So that's the point where when you watch this show, is like, I piss a lot of people off. It's like, sorry, that guy that you put they all lie, because that's the path to get. If they told the truth, it's a very grim picture, and they're not going to tell the truth. So they become unelectable.
Wouldn't get elected.
Completely unelectable if they told the truth. So people aren't ready for it. Just the viewers of this podcast are ready, but even what we say, we know it won't be palatable to a lot of people because they're not ready to hear the truth, right? So,
well, the point of this is to get people on the life raft.
On the life raft.
Get on the life raft. Money's fake. Borrow the fake money. Buy real assets because you can. You can do it.
Because we still can. Because it's insane that we still can. Yes. When you see what the underpinning of the money is, the full faith and credit of these governments is bizarre. They have no credit. They're broke. So when you look at the U.S. government, they have $36 trillion of federal government debt, and they only have $5 trillion in total revenue. Wow. So their debt is 717% of their revenue. Where in Canada, it's only 354% of the revenue.
Still terrible.
Terrible. But we're discerning different shades of terrible, and one is dramatically worse. Okay, and so why is the U.S. output so high right now compared to the G7? It's not because they're entirely more productive. It's because they're on a massive debt binge. I'll go further because it gets worse.
Well, I think according to Chrystia Freeland, I think it was last year, said just stop your Disney Plus subscription.
Disney Plus is going to fix this.
Maybe that's what they got to do is stop their Disney Plus subscription.
They should stop their Disney Plus subscriptions. Probably they're a little bummer, so they're going to have to stop their Disney Plus and their Netflix. So, okay. Now, let's reel it back in because we already know, okay, this is a better way to look. Now I'm starting to get like, how do I look at this as a fractional CFO? Because I look at this, I'm concerned. My debt to my revenue is 354% versus 717%. That on its own is not necessarily insurmountable. But here's where it starts to get really, really ugly, is you're going to look at the total federal, provincial, state, and municipal debt. And then I want to compare it to our sovereign wealth. And people don't know, it's like we do have a sovereign wealth fund. It's just called CPP, okay? And the U.S. does have a sovereign wealth fund. It's just called their Social Security Trust Fund.
Sure.
Okay? Now, one could suggest it's comical to call them a sovereign wealth fund because they're invested in such bad stuff, but that's a different discussion for a different way. That could be changed. Like, that could be changed anytime they want to, okay? And I would suggest that could be changed with smaller political resistance. But the amount that's in there today can't. You know, you could start deploying it into more efficient assets. That could change with an election, but you can't change the value.
Right.
The starting point's the same. Okay, so in Canada, we have total federal, provincial, state, municipal debt of $3,805 billion. Okay,
Right.
and our sovereign wealth fund, which is our CPP, is $1,061 billion. So that means our debt is 359% of our wealth. Here's where we start talking about, like, if I'm looking at this as a corporation, it's like, this is bankrupt.
Yes.
Okay, this is bankrupt. I think it's different shades of bank. I'll keep going through it, right? But the U.S. it's like, they have $40 trillion in
41
in all levels of government, $41 trillion, and they only have $2.7 trillion in their Social Security Trust Fund. They have it's 1,506% of their total wealth.
So that's when they cut up your credit cards, right? They confiscate your car. They take all your stuff away and say, no, you can't spend anymore. That's what would happen to us. I mean, way before that, like 1,506%.
I mean,
like your savings are. They're not savings.
I would suggest this is the point where they cut off the credit cards. They start calling and cutting off the credit cards. And this is the point where, like, your car's getting towed and the police are outside because you've run up someone else's credit cards at the same time. like this is like we do consults with these sort of revenues. And,
right.
and they're tough consults where we're telling people, like, I'm sorry, like, this is a consumer proposal. This is a bankruptcy procedure, right? And there are paths out of that, right? For individuals, they're ugly and they're not pretty, but if you have a way to earn income, it's like it's better than being poor forever,
right?
Okay.
There's paths out for governments too.
There's paths
potentially.
Out. Yeah. But this is the point where
unelectable, but possible.
And so this is like the type of rate. Now, we don't come in with it. No one comes into our office with $3 trillion in debt. But people come in with that sort of ratio, okay, right, where their debt is 359% of their wealth, okay. We start getting like large debt loads, though, like anything over $1 million. Like, of course, broke people can get like really, really wild numbers, right? But you start getting like people with assets over $1 million, and they have ratios like this. The question is like, how the heck did you do it? You're broke too, but it's like, how did you actually get here? Because governments can do it because they got a money printer, but individuals don't have a money printer. So we start looking at that. You start to wonder, like I said, you're running up someone else's credit cards. There's usually, potentially illegal things that are happening in order to get that sort of ratio here, where your debt is.
I'm pretty sure we can draw some parallels that some illegal things were happening in order to get that much debt.
Yeah.
Come on.
It is just, and there would be another layer here that we need to look at is the deficit. This is our deficit, because people, we're going to grow our way out, people. We're growing our way out, okay? And in Canada, we're like right at the red line. You know, when we look at our total debt to our sovereign wealth, it looks like a bankruptcy issue. In governments, they have a money printer. We don't have a money printer. So the idea is, you know, on a private side, you don't have this, right? No one's going to lend money to an entity or person that's burning through cash flow. Okay, that's not what's going to work. But on the government, they can just print the money. Okay, right. So they will say that we can grow our way out of it. And in Canada, we're pretty much right at the red line. 65, our deficit. So the amount that our expenses exceed our revenue every year is $65 billion. $65 billion, right? Of course,
and that's just the number they reported recently.
Recently, right? I mean, well, they threw in the extra 20 billion at the last minute. Remember, they thought it was
supposed to be 40, then it was 60, and now there is no budget. So
yeah, who knows what it is?
We'll tell you later. Wink, wink.
We were right at the red line, anyways. Okay, and that's at 2%. Like growing the economy by 2%. Remember, what's inflation going to be? 2%.
Right.
2%. Right. Don't tell them that the world's increase of gold production is 2% for the last couple hundred years. But why did they choose 2%? That's a different story. Okay, deficit to GDP. On the U.S., and you can get these numbers, right? You can get these numbers. You go to the same StatsCan report here. Okay, so we have the federal government. Where is our deficit? Right here. Here is our net operating balance, $65 billion. $65 billion. We bought some financial assets and borrowed another $68 billion. Okay, that's where it comes from, right here. Okay, and then our GDP is still the same number we've been talking about the whole time. Okay, and then on the U.S. side, they have a deficit of $2 trillion and $8 billion. Okay, $2 trillion and $8 billion. You go to usdebtclock.org. Here it is. Here is the deficit, and then that's still their GDP. Now, I'm going to look at this as a percentage point. It's 6.7%. Now, they told you, like, all of this stuff about Doge. It's like, you know, we're going to cut $1 trillion from... They didn't cut it, people. They came out and patted themselves on the back that it's $165 billion. And then you watch Trump and Elon fight on TV. It's like, people, they're both very smart people. Neither of them actually thought they could cut $1 trillion out of it. Like, that was like, they knew it wasn't true. It's like when Elon sold you the Cybertruck 8 years ago and said it was going to come out next year, and now the people are just getting delivered their Cybertrucks this year. It's like, like they knew when they said that they weren't going to cut $1 trillion out, because you know what happens when you take $1 trillion out of an economy that's at 30 trillion? It's like that's like a Great Depressionary type event. Even if there was $1 trillion, like, it would be a Great Depressionary type event. And when you start looking at the line items on the budget, you'll start to realize that the only way to cut a trillion or two out is to eliminate either Medicare, Social Security, defense, or default on the debt. Because you could get all the other items on the budget to zero. They're not enough to equate that number. So you have to take something, you have to disband the military or cancel Social Security. So they knew that going in there, right? That was a certainty. So you start looking at this, it's like our deficit to GDP. If you could, so that means we're adding 2% of our GDP to our debt every single year, okay? And the U.S. is, you know, they're adding $2 trillion to their debt every single year. That's 6.7%. So they're telling you they're going to grow out with AI. Okay. Think about that for a second, people. So, like, that means AI is going to come in and make people wildly more productive. You know, like, what AI is going to do is it's going to displace people. So some people, you know, those people who are driving the Uber or doing the skip the dishes is like the low-level people in virtually every profession. Virtually every profession, they will become redundant. People like think one profession is going to be great, the other profession is no. There's going to be low-level people in every profession that are going to get replaced by the robots, and the high-level people will become wildly more productive. They will become more productive, but then you have some of the low people. They are sitting at home. They are sitting at home. That is what's going to happen. So we keep saying we're going to grow our way out of this. that they're going to grow a mature economy by 7% a year. Like 7% a year, people, that's like what China grew by in the late 90s and early 2000s for a period of time. That's an immature economy, a developing nation. Like that. There's no history where a mature economy is going to grow by that point. It didn't happen with the internet. It's not going to happen with AI. I'm not saying AI is not going to make people more productive, but like 7%, it's like, yeah, I want my car to fly too. It's that's not going to happen. Okay. And so you start looking at this. Here it is. Here's the gross domestic product growth, Canada versus the U.S. Okay. What did Canada grow by last quarter? 2.2%. Kind of surprised to the upside. But even 2%, it's like, that's about the number. I hear people say 3%. And you've heard like Warren Buffett say that the government, like no one in government should be able to run for re-election if the deficit is bigger than 3%.
Right.
I think it's 2. Like, I think it's 2 because there's no evidence in history that suggests that you can grow beyond 2 reliably. Like, it's very speculative, right? But the U.S. saying that they're going to grow on average by 7%. They had one quarter in the last 24 months that was anywhere close to that. What was the last quarter? It was negative. The last quarter was negative. So when they're telling you they're going to grow, it's like, they're not going to grow out of it. They're not going to cut their way out of it. They're not going to grow their way out of it. They're going to print their way out of it. Yeah. They knew it when they got elected. They knew it when they told everyone about Doge. Carney's telling the same thing. We're going to grow our way out of it. You're not going to grow your way out of it. You're going to print your way out of it. Like, that's what's going to happen. They know it. The people telling you that, they're not, like, Carney's not dumb. Trump's not dumb. Elon wasn't dumb. They knew it from the beginning. Elon just got pissed off because they cut his subsidies. They cut his EV subsidies. He's like, we're going to print our way out of it, but I'm not going to get as much of that printed money that I thought. Now I'm mad, right? Like that's what happened, right? To say that Trump was mad because I thought Elon was going to cut $1 trillion and only cut $100 billion. Like, they knew at the beginning that wasn't going to happen, right? Or maybe they knew they were going to fight the whole time, and some people just wanted to buy some Tesla stocks on the cheap too. You can't put that past people. So
yeah, that's true. I mean, conspiracy hat goes on.
When you look at this, it's like, that is bankrupt. That is bankrupt. The debt is 1,506% of your sovereign wealth. This is wealth because this is an amount I'm going to have to pay interest on. This is an amount that I can deploy to make a rate of return on. So what should that be? If I'm looking at a private company, this number here should be twice as big as this number. If I have $3.8 trillion in debt, I should have $7.6 trillion in assets to deploy. The debt itself is not bad. The ratio between the debt and the assets that I have to deploy is wrong. Okay, so I start looking at the revenue. It's like, I could fix this if this was on track. Okay, and here we're just basically barely hanging on.
Right.
Barely hanging on. Why do they have to increase the population by so much? Because that's where all our GDP growth is happening. It's not,
we're not more productive, folks.
Per capita. It's just more people working on the problem, basically, right? Working in the same broken system. Okay. I'm gonna go to our last thing. It's like, when does this end? People will ask, like, when does this end? This ends in one of two ways. It's like, we're going to go back to hard money. Like, we're going to go back to hard money. We teach people in the bootcamp the 5,000-year history of money, and we start to realize that the current monetary system is only 53 years old. It's definitely broken by every metric. When you look at wealth gaps, when you look at the division between rich and poor, how much wealth is being concentrated at the top 1%. It's like, that's not the system malfunctioning. That's how the current system is designed. It's designed to move the money from the people who do the work to the people who know how to borrow money smartly to invest. Like, that's how the system, is the system. You can't fix that system. You need to change that system.
Yeah.
The little tweaks to that system, it's not going to work, okay?
No, for me, it's a failed experiment. Like it's failed. It's obvious it's failed. Just show the U.S. debt clock. And I don't know if it lasts 100 years or maybe another 5 years, but it's going to fail in tremendous fashion. But for now, like people can still borrow the fake money, the fugazi, to get the real stuff.
That's right. Yeah. And it's like, when does this end? It's like it ends when people understand that it's a scam, right? And it's hard to think that, will people actually figure it out? They will. Just for those of you who are old enough watching this show, there was a time when we couldn't use the internet. Mm-hmm. There was a time when we couldn't do online banking. There was a time when social media was not even a thing. Email wasn't a thing. You couldn't just email someone, right? And when all of this stuff came out, none of us knew how to use it. Like none of us knew how to use it at all, right? Mm-hmm. And even the people teaching the system, they have no idea. It's like I can remember in high school doing CTS, Career and Technology Studies.
Yep. And
you could pick, it was like a choose your own adventure. You could pick different things. You could do this and one of the things was you could build this computer. And you could build this computer, and not many people had computers. You could put it together, and you get your credits for putting together the computer. And then I put the computer together, and then I flicked it on, and the thing turned on. And I went and showed the teacher because I wanted my credit. Wanted to move on to the next unit. And he looked at me. He's like, "The computer turned on." I was like, well, yeah, that was the assignment, was it? He's like, yeah, to put it together, but no one ever got it to turn on before. It's like, I just been giving people the credit. So the guy teaching the course didn't know. I don't know why mine turned on and someone else didn't turn on. I was just following the same instructions. Maybe I flipped a switch or something, but he was surprised, right, that the computer turned on. But this is like, this is life in the 90s dealing with technology, right? So it's laughable today that was, getting your credits for that assignment. And that was the guy teaching it, had no idea how the equipment worked, right? That's kind of the scenario we're in right now. The people teaching these subjects have no idea how the equipment works, right? And so when does it end? It ends when the financial education of the average individual gets better. And people say it won't. It's like we all didn't know how to use the internet one day. Mm-hmm. We all didn't know how to do online banking. People didn't know how to do email, but they figured it out, and they figured it out at a necessity. But I mean, when you look at network rates of adoption with hard money, like only 3% of the population owns any Bitcoin. Which is insane in this sort of scenario, when you know that the money is backed by the full faith and credit of these governments who have none, that are broke, that you have no hard money. And even the financial institutions, supposedly the experts giving advice, don't recommend any gold or Bitcoin at this point. You walk into the RBC, which is insane. They don't recommend any allocation to the assets that's held its value for 5,000 years.
Buy bonds.
Yeah, and they want 40% of bonds, and this backed by these guys, right? Like it's just it's insane. So like eventually the understanding will change, but we're probably 10 to 20 years away from that. If you look at network adoption rates and compare it to people's understanding of Bitcoin, for example,
sure,
it's probably 10 to 20 years away for, till you get to the point where even 51% of the people start actually owning it and starting to understand what it is, right? Then the other point is the suddenly all at once. Like okay. we where the system breaks. Okay, where does it break before people figure it out? Before people figure it, kind of like a 2008 type event where the system just shuts down, immediately overnight. And, there's some clip of someone going up to Trump saying like, it's over, come in, stop what you're doing, stop this press conference, like the system's blowing up type thing.
Time to go to the bunker.
Yeah. Where does that happen? The closer and closer you get to this metric, now these two metrics, these metrics here kind of alliterate that we're bankrupt, okay? But because we're in a money printer system, where does it become completely untenable? It would be when the interest expense is equal to the entirety of the government revenue. The fact that we never do this in a private business because these three other these two stats would be the relevant stats here in the private business, right?
Immediately bankrupt, stop.
Yeah, or these three stats would be the, but this in our crazy fiat central bank system where they create money out of thin air, this becomes, it's just untenable. The closer and closer you get to 100%, I can't see any scenario where it gets to 100% where it doesn't blow up, but the closer you get to it, the higher the probability where the bond market blows up, which means the government tries to borrow another dollar and no one buys. Like, no one buys. Like, why would you buy if, like, no one will buy if the interest expense exceeds the entirety of the government revenue? Like, the closer you get to that point where, you know, the government goes to borrow more money because they can't balance their books and no one buys it. All of it is going on the central bank's balance sheet, okay? And right now we're at 10% in Canada and 20% in the US. So by every metric, the US is in a worse fiscal position than Canada. By every single objective metric. But, you know, branding matters, people. Like, branding matters, right? It's like
they are the world's reserve currency.
They are the world's reserve currency. I mean, there's a reason why these three watches on the table, one of them costs $300, one of them costs $600, and one of them costs $16,000, and they're all GMT watches, right? They're all two-tone blue and black GMT watches, and they all do roughly the same thing, but you know, one of them sells for substantially more than the other two. In fact, the other two aren't worth as much as the case that they're in. There's branding. Okay, right. That's a branding. That is the world's reserve currency that's used for better or worse. So they have the propensity to borrow. Okay, and so that's why we could not borrow like this in Canada. That would happen much closer to 100% than it would. You know, we can't get to anywhere close to the U.S. can get. Like, they're going to go first, right?
We can't borrow or print that much. Like, our Canada savings bonds aren't really favorable.
Yes.
And there's no way, like, we'd get enough people to buy them.
Yes. So this ends in one of two ways, where people themselves start to figure it out, but we're far away from that, people. Like, I'm telling you, the people watching, you know, the people who come to our boot camp, the fact that we sell tickets to a boot camp that's $200 and we show people how to increase your net worth by $1.2 million is insane, right? And the fact that it's not because people don't recognize the severity of the problem yet, right? They don't realize the information that we're giving away basically at those boot camps. But as we get closer and closer to that, like, people are going to figure out the solution, which is hard money. They're going to start to realize that they can't spend all of their time working for a currency that can be printed out of thin air.
That's right.
And they're going to have to work for real assets. And the fact that we can still borrow fake money, it's getting harder, but the fact that we can still borrow fake money to buy real assets is insane, based on these metrics. Okay. And, you know, so either the people figure it out because the learning curve increases, but we're 10 to 20 years away before people actually start to figure it out for themselves. But the problem is, do people figure it out first, or does it break first because that gets closer and closer to the red line, which is 100%? And it would seem like, well, it's only 20. It's far away. It's like, no, this is like an exponential curve. This is an exponential curve. Just the U.S. rolling over their current debt. Just if their current debt of, you know, let's call this 40, starts to roll over at 5%, and all of a sudden, you know, this gets to $2 trillion instead of $1. All of a sudden, like, you know, now all of a sudden you're getting to 40% overnight.
Well, yeah, I mean, you look at that, if it goes to $2 trillion, what is the interest rate at that time? Yeah,
the path to 50% is much slower than the path from 50 to 100. It starts to spiral up into what we call a debt spiral, because that interest expense gets tacked onto the debt, and the debt itself gets less and less attractive, and people want a higher and higher rate of interest to take on the debt because of the risk.
Right.
So it starts to spiral up. So the closer and closer this gets to 100% is the risk of the suddenly all at once moment, right? And I would still say the likely scenario is people figure this out first. We got 10 to 20 years. We're 53 years into this thing. People are probably going to figure out into 10 to 20 years, and you will slowly. It's not that the fiat system is going to go away. It's just it's going to run in parallel to a hard money system, and there will be less and less emphasis on the fiat money system over time. But when you start to look at these numbers, it's like objectively, like when I assemble these numbers, like, holy smokes, the probability of a suddenly all at once moment is actually higher than maybe I'm considering, right? It's not like it's a 1% scenario. It's it's a greater than 10% and less than 50% scenario where it just blows up all at once. Or you wake up one day and, gold and Bitcoin are worth $100 trillion. Within the span of a couple of months, right?
That's crazy.
And all of a sudden, we would get a central bank digital currency ushered in right away, try to fix it. It wouldn't work. It would fail, right? Ultimately, it would fail for the same reason that this thing failed. You have to produce something of value to give something of value. You can't just print money out of thin air, whether it's paper or digital. So
yeah, that's right.
And so this is the number to watch here. It's that debt to GDP. We talk about it, but I'm telling you, it is the interest to the total revenue. 10 in Canada, 10% in Canada. Our interest is 10% of our total federal government revenue. In the U.S., it's 20. That's the number to watch. The closer it gets to 100%, like it blows up by 100%. Likely blows up well before 100%. But where would the market tolerate? It's hard. Creatures of habit. Like we still, the banking system is very ingrained. People still buy, like, you buy life insurance. What are you buying? You're buying an allocation to bonds. That's what you're buying indirectly. Is predominantly you're buying an allocation and an allocation to bonds. It's like that's all it is. You're buying an asset that's going up by 5% when you could have bought desirable assets that go up by 10%.
Yeah, I mean they're highly regulated, so they're legislated to buy bonds.
Yes, yes. So there are a lot of institutions and investment vehicles that are the banks themselves. The banks themselves are required to hold bonds as a reserve asset, whether they think they're a good rate of return or not. They're required to. And so, what are they going to tell their customers to invest in? Bonds, because if they got the customers out of bonds, they're reserve asset creators. So I mean, this is the asset to watch. Careful with this reported debt to GDP number because it's massaged. It's different in different jurisdictions. It can be made to look the same. It can be made to look much better in Canada, and but ultimately, it's like the U.S. is worse in terms of where their debt is right now. But because of branding, they can borrow higher. But ultimately, you're just looking at different shades of bankrupt.
Yeah, and while we were distracted last night watching the Oilers play, that massive distraction. While that was going on, Israel was bombing Iran.
Yes.
Interesting. So for me, all I hear is the sounds of the money printer getting started, getting fired up, gonna print some money, buy some bombs and guns and planes and tanks and stuff, so that we can project and kick this fiat currency down the field a little bit further. So what is a silver lining? How do we avoid going into war, some stupid black swan event, so that we can keep our society living without our faces melting off through thermonuclear war?
Whether there's the reckoning event all at once is probably the worst case scenario. That's the worst case scenario because you get a rapidly declining quality of life for the American populace and the American electorate, who are ultimately in control of a large military. Like that's what would happen. Like, what does the U.S. produce? It's not a whole bunch of natural resources. They're not manufacturing. They're not the world's leading manufacturer. It's like they export fake money, and people still buy it for now. But if all of a sudden people wouldn't buy it and you had a reckoning all at once, it's like all of a sudden you have a rapidly declining quality of life for a populace, for an electorate, voting on a government to control a very powerful military. So that's not ideal. People figuring it out for themselves is more ideal, and adopting hard money themselves, and people figure them out themselves. Like you see it in poorer countries where the Bitcoin adoption rate is higher sometimes in poorer countries because out of necessity. They know there's nothing else to buy, so they will do anything to buy an asset that they can move out of the country. Okay, and so that's a better scenario, but that probably in itself is still, it wouldn't the quality of life for Americans wouldn't decline as rapidly, but it would still decline under that scenario. It would still decline under that scenario more predictably, but it would still decline. That still has not as high of probability, even at the all-at-once moment. It doesn't necessarily lead to a war, but it's the highest probability of war. And then moving down the risk section is people figure it out at once, but the government, has no part of it. It's just people start adopting hard money again. And it's like, and that might like shock people, but when you study the history of money, it's like, well, basically for the first 2,500 years of money, government had nothing to do with it. And then for the next 2,500 years of money, governments decided to stamp their heads on gold coins and change the composition of those gold coins over time. And now we have 53 years where we just ignored any backing whatsoever. And so that still has a probability of war. And there's probably not a lot we can do about it other than recognize the probability of that sort of event. The single biggest thing, though, is does the U.S. government meaningfully adopt Bitcoin as a reserve asset? If the U.S. government adopts Bitcoin as a reserve asset and backs the fake dollars by, they're already the largest holder of gold, and then they simultaneously back it by Bitcoin, which is the best performing asset and the fastest growing reserve asset. Objectively, by far, people might not like it, but it's the best performing asset, and it's a $2 trillion asset. It's bigger than any commercial bank by a lot, right? If they do it, that's probably the most likely way to avoid war because it would preserve the world order. It would still over time move the money. It would slow down the movement of money from the people who borrow the fake money to buy the assets and start moving the money for the people who are actually productive, supplying the goods and services that people actually want. But it would happen so slowly that the chance for war is probably the smallest. And so the U.S. government buying Bitcoin, in my view, would be a good thing because the probability for World War III type of thing goes down in that scenario because the world order would be, likely preserved.
Gotcha.
So, that's what we have here for you today. This is the number. So hopefully that's useful when you're hearing debt to GDP numbers on, actually understanding what they mean and what, how they're misrepresented at time, and then the numbers that you actually should be looking at to come to the conclusion that the fake money is broke. We have to, we have to buy the real assets, and any opportunity you have to leverage, to use leverage to acquire the real assets. It's not that debt is wrong. It's that the proportion of debt needs to be reasonable. You cannot be the federal government. You will go bankrupt if you try to do it anywhere like the Canadian federal government to the U.S. government. You will be bankrupt. But with the right ratios, you can do it and really increase your net worth, because over the next 10 to 20 years, it's like simultaneously the fact that we still have the opportunity to buy the crazy bad fiat currencies to buy real assets is also it's a massive opportunity. It's a problem that most of the population will get run over, but if you learn how to play the game, it's a massive opportunity to increase your net worth.
All right. Well, thanks, Josh, for all of that wealth of information. I hope that you aren't overwhelmed. If you are, just rewind and rewatch this video content. Show up at the bootcamp. If you want to learn how to get on the life raft and start investing in real assets, go to spurrell.ca and click on the bootcamp tickets link and get your tickets today.